We didn't even get into how a whole life policy might be able to help you before your business partner passes away. We're getting there. Just hang tight with me. In fact, first of all, let's go to a case study. We'll refer to this as Johnson and Smith partnership, okay? So John Johnson and Michael Smith, which is kind of an amalgamation of several real clients I've worked with. So their stories have been kind of sliced together here to help you see the big picture. But John and Michael ran the Johnson and Smith partnership. They started this successful tech consultancy firm in 2010. And they recognized early on the need for a buy-sell agreement to ensure the business's continuity if one partner passed away or became incapacitated. Their attorney brought this to their attention. They had suggested some term insurance, the attorney did. But John had been reading through the Bank on Yourself Revolution book by Pamela Yellen and decided they wanted something that would give them even more than just a pure cost for the insurance they wanted to purchase. They had looked into then a whole life insurance policy and found it was a great fit for what they wanted, not just if one of their business partners should pass away, but all they could use the policy for during their business years together. So next step, let's implement the plan. Year 1, in 2011, John and Michael meet with us to discuss their options. They decided to use whole life insurance policies as the funding mechanism for their buy-sell agreement. Each partner took out a policy on the other with each other as the beneficiary. So this is known as a cross-purchase buy-sell agreement, where the owners purchase policies on each other. So this ownership structure meant that the business could not write off premiums as a business expense. However, it also meant that John and Michael could use the cash value later on in retirement as a tax-free supplement to their retirement income. So they were thrilled to set up the ownership structure this way. But remember, you can own these policies within the business. That's called an entity purchase agreement. We might talk about that later. Okay, so fast forward now, year 5. By this time, both policies on John and Michael have accumulated significant cash value. They've been paying annual premiums of $20,000 each. The cash value was growing at a guaranteed rate, and dividends from the insurance company were also increasing the value as well. And over the last few years, John and Michael had needed to borrow from the policies a few times, twice to cover payroll during lean periods in their business, and once to pay a large tax bill that the business owed during their most profitable year. Not too shabby. And they loved using their policies as, in essence, it was a line of credit to themselves for their business. They felt it was their secret weapon and a way to gain an edge over their competition. Okay, fast forward to year 10, that's 2021. At this point, the cash value in each policy had grown to about $250,000 or $500,000 total available now for business needs. And the death benefits were approaching $1 million, which was about enough to cover the buyout if needed, given the business valuation at that time. However, they continued to fund the policies to accommodate that business's continuous growth. They also continued to use it as a liquid source of funds when necessary. They would borrow from the policies and strategically pay their policies back with business profits. Now, we're now in year 14, so fast forward with me to 2024, year 14, tragedy strikes, and Michael Smith passed away unexpectedly. Now, the life insurance policy on Michael paid out $1 million to John, in which, due to his buy-sell agreement, he was obliged to and automatically used the money to buy out Michael's share from his estate. This meant he sent roughly $1 million to Michael's surviving spouse. And this allowed John to maintain control of the business without any financial strain, and Michael's family received the agreed-upon value of $1 million for his share of the business. So what was the outcome here? The policies provided not only the funds for the buyout, but also had a built-in cash value that could be borrowed against for other business needs over the years. This dual benefit ensured financial stability for their business and the continuity of the business should one of them pass away. Now, that's a beautiful story, but here's a very brief epilogue to the story. The policy on John was sold from Michael's estate back to the business. The business bought it from Michael's estate for about the cost of the cash value at that time. So John's business now owns the policy on John's life. The remaining policy on John can be used as a liquid asset on the balance sheet of the business. And one day, When John retires, he can use that policy as a source of income and as a means to sell his business at a higher price. All this is incredible, and it's a very simple solution that doesn't require a lot of complex trust work or equities or understanding of complex financial strategies or estate planning documents. It's a very straightforward way to solve the problem of business continuation. So here's just a few final thoughts. Now, there are many different options our prototypical business owners, Michael and John, could have taken, and all of them have benefits, but also considerations. The first is, how do we set up the buy-sell agreement? Specifically, who is going to own and pay for the policies? I mentioned that these policies were owned by John and Michael, and that's called a cross-purchase buy-sell agreement. But there's also an entity purchase or redemption buy-sell agreement. So an entity purchase buy-sell agreement differs in who owns the life insurance policies and how the buyout is executed. In a cross-purchase agreement like Michael and John had, each partner or shareholder takes out a life insurance policy on the other owners. So upon the death of a partner, the surviving partners will use the insurance proceeds from the policy that they owned on the deceased partner to buy out the deceased interest directly from the estate. So that'll increase their basis in the business for tax purposes, which is kind of nice. And the setup, though, requires each partner manage multiple policies. So this is no problem with John and Michael just being two business partners. But if you got 6, 10 business partners, this can be very complex with businesses with many owners. Conversely, in an entity purchase buy-sell agreement, the business itself owns life insurance policies, just one on each of the partners or shareholders. So when a partner dies, the company uses the insurance proceeds to redeem the shares of the deceased directly. So it buys back the shares from the estate. So the family is made whole, but in this case, the method simplifies policy management since there's only one policyholder, meaning the business, but it might not provide the same tax benefits to the remaining shareholders regarding like step up in basis and that sort of thing. So there's obviously some consideration here, some nuance here. Each business needs to consider which ownership structure they'd go with. Part of my work in meeting with business partners is to really discuss these options and really weigh the benefits and drawbacks carefully and considering, what the business really needs. So if this has got you thinking, and you'd like to pursue possibly a buy-sell agreement strategy in your business, even if you don't have business partners yet, we can set something like this up.